Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, September 23rd, 2022. What I'll do in this video is certainly an update on the equity markets, the VIX. I got to post out to you there. Definitely some things worth pointing out and watching as we head into next week. Then I'm going to tie in updates on cryptos, gold. Somebody asked a question about GDX, so I'll get to that in this, and Treasury bonds and the U.S. dollar. Everything I've been watching, they all really tie in together. All right, let's start out with the stock market. Here's the S&P 500. You can see today. I'll turn off all these lines. We made a perfect, but just about a perfect test of the recent lows. Now I'll say this. I have seen it happen where you just, go on past there and don't have even a slight reaction, but it is extremely unusual, especially on a Friday. You've got, I think what we saw today, we saw a little lift into the close, and it reeks of short covering to me, especially in front of a weekend. But again, unusual to not see dip buyers at least nibble. Because it's still, you've still got, at this point in time, we have divergence here on the PPO, and now we do. Remember, we didn't before, and now we do. So when I put a line here, it's going to populate those other lines. Call that an equal low. You can see at this point in time we have higher lows, at least in the PPO, but not so much. You'd have to go all the way back to this point, and that's a little too far. This purple line was for that divergent low, so was this one here. At this point in time, we've made a slightly lower low on the RSI, but if you want, we can just call it an equal low, close enough. Now, for that to happen, we'd have to turn up very soon, otherwise we go lower and we don't have divergence. It's also what I call potential divergence. You already had a rejection where it looked like the PPO was curling up here, it got rejected. And now to confirm the divergence, you'd have to rally next week pretty good and then get a bullish crossover on the PPO with these lines here and effectively put in a higher low against equal, or if we undercut it slightly on Monday morning. I don't think that's going to happen, but hey, respect if it does, because that would be a positive divergence on the S&P 500 daily chart. You still, by the skin of its teeth, it's still clinging on to some RSI divergence on the 60-minute chart. However, if you look closely here, this was our most recent divergence right here on the PPO and MACD, but now we've taken that out in the S&P 500. The PPO, you can see clearly, has now undercut, and so that divergence is gone, and that's something I wanted to see for the bearish case, which I still maintain. And equal lows there in the RSI, so barely divergence. But like I said, we'll see next week. I have a strong feeling we're not going to flounder around. Next week, this market's most likely, in my opinion, either going to crap out, or over the weekend or Monday morning they come in and some news-driven event that can set the buyers in here and spark a short covering rally. If that happens, I will tell you right now, potential bounce targets and areas that I would be looking to add shorts, because any rally I think is going to be short-lived. Right there's the top of really today's the top of today's gap. That's from yesterday's close down to where we were. Let me turn off the after hours trades. Those kind of skew things here. Regular session, there it is. So you look real close, see right there. That would be a natural target if we pop up Monday, an objective shorting entry in my opinion. Also, if you're bullish, then you could add to it as long as we don't take out the lows. I always tell you, what I'm doing, and then what, if you look at things the other side of the coin and you're bullish, you could certainly set a stop below the lows and let it run. And but these are the resistance levels that, if hit, especially this one there about 381, are likely to cap any rally in my opinion. Now it works the other way. If they're taken out, then bullish. Take one out, you probably take the next one out. Massive resistance up there. And I can just tell you now, if we happen to get some type of catalyst that gives us a rally next week, I would be shorting with both fists. I might be riding that up if the charts tell me to. But coming around 389, 390, big resistance in my opinion. And first things first, like I said, I still favor more downside. Now let's look at QQQ and then the NASDAQ 100, and then we'll move on to those other things. QQQ, unlike the S&P 500, did not make a test of the lows close, but no cigar. You can see right here. Here, I'll draw it out for you. There's the previous low. Again, for all intents and purposes, you could call it that. There's the low right there, and came a little bit above it. Maybe if I put in the NASDAQ composite, COMPQ, or the NDX itself, maybe you'll see that. Let's see, I'm just curious. Nope, not on the comp. And NDX, the actual index that QQQ tracks. Nope, same thing. QQQ does a really good job of tracking. So, all right. Big picture. Big picture is if it did undercut slightly and there's some type of reversal, yeah, then you would have negative divergence. As of now, we do not have negative divergence because prices haven't made an equal or lower low. And I also want to point out that you'd only have it there on the PPO, not on the RSI, because you already undercut the previous lows on the RSI. So I don't think we're going to get that. I favor more downside. I told you before this week, especially after the Fed and even going into that, this is usually the point where we get that. If you're going to get it in a bear market, I suspect we'll get that what I call acceleration in selling. And again, since we got rejected, that was where the S&P 500 got rejected off the 200-day simple moving average, and QQQ hit my bounce target zone, and we reversed short there. It's been acceleration. It's been nothing but red sticks. We had 1 week of a green candle so far, and now this week's over. So 1, 2, 3, 4, 5 out of 6 weeks of relentless selling. Last time we had selling like that was right here. And if I'm correct, then it's going to continue next week, and next week it should accelerate. So as much as we were down today, closed down 1.63%, and that's after rallying about 1% off the lows. I think you're going to see, there's a chance that you'll see even more powerful selling next week, unless, again, I got that post out to you on the VIX. We're right on the line. We're at support on the S&P 500. Major reaction low, just a hair above in QQQ. We're at major resistance on the VIX. I'll get to that in 1 second. So, as I like to say, support is support until unless broken. You can't bet the farm on it. But if those levels get taken out, if the lows get clearly taken out, especially the more lower we go, build on those losses next week, the VIX breaks out, it's going to sharply increase the odds of that final quick thrust down to my next target there, which is about still from where we closed today. Let me try to grab about that point. Still another 15% lower, 14.5, 15%, give or take, down to that 235 level. And also there it is. Let's see. Here it is, weekly close. It's not much, but take it for, let's take things on face value. Sometimes I tend to overthink things, and sometimes I like to just take things on face value. There's that PPO, bearish PPO crossover I was talking about on the QQQ weekly chart. The last time we had a bearish PPO crossover on the weekly was right here. You decide, did you want to go long or short at that point? That was the best shorting op in decades right there. At least years since the COVID lows, since the big drop in COVID. Actually more. We dropped 35% so far, 34. So that was even bigger in QQQ. COVID, we only dropped, what was it? I know the S&P fell more. The Qs, high to low, just fell 30, showing me about 30%, 30 and a half, 31 we'll call it. I think that's what it was. All right, so that's that. Got the PPO crossover there. Let's see if we got it on SPY as well. Oh yeah, there it is. Remember, the weekly charts are now finalized. So there's your bearish PPO crossover in SPY. The last time you had it was right there, and that was exactly about just over, these are weekly candles, about a month before, but mere basis points, meaning a fraction percent before the all-time high in the S&P 500. So again, that was the last one we had. All right, let's look at the VIX now. And I got that one out to you earlier. You could trade the VIX if you want. There's VIX tracking ETNs. Just be careful. Know that there's a few years back, we had a surge in volatility. Some of those VIX ETNs should have went to the moon, and instead they went to zero. They blew up. They are ETNs, not ETFs. ETNs are basically just an IOU, a promissory note from the company or the bank that's running them, and they're using derivatives to track, and they do well in a normal environment. But sometimes when things really get out of whack and the financial markets get a little wonky, they can and have blown up. ETNs have blown up on the VIX. There were several back then, at least two, maybe three. And so you could trade the VIX raw. You can trade VIX futures or options on the VIX futures if you know what you're doing there. And if not, just I use this to just show you it coincides with the stock market. The VIX is a perfect, near perfect indicator for looking at what the stock market's going to do. And so we've been walking up. This is a weekly chart, same one I got out to you today. You can see these trend lines right here. You look at these downtrend lines. These that I just highlighted there have the same, almost identical slope of this trend line. So what happens is when the markets get a little shaky, there's a fourth quarter, the biggest corrections, and technically speaking, they were bear markets that we've had in decades since the financial crisis in '08 came here in the fourth quarter. Actually, this one was the fourth quarter of 2018, but before that, you had some volatility. You had a sharp drop there. The VIX broke out and exploded higher. Then you had a breakout here, gap away breakout, exploded higher. That was COVID. And now you have a comparable trend line. And basically, we ran right into it today. And look, I got that post out to you a couple hours before the close. We didn't take it out today. And again, it could have happened before the close today, but usually heading into the weekend, like I said, short sellers, if the market's got a lot of bearishness, you're going to get those shorts covering, and that's what happens. So you got a little bit of a relief rally. So for all intents and purposes, that was another successful test, just like these here. But you can see we're just pushing. We're right there. So it lines up exactly with the markets. We had the S&P 500 successfully test and hold the lows from the previous lows in the bear market. QQQ just a hair above that. And so next week, if we take out today's lows by a good margin, you'll also most likely see the VIX break out. And when the VIX breaks out of these trend lines, it doesn't just meander around, it explodes. And so this meshes with what I'm saying may happen next week and in the next couple weeks here. Maybe, maybe not, but that's what I think is a good chance. It's as good a chance as we've seen, as I said the other day, for a market crash type scenario with very fast, hard, impulsive selling day after day. This is as good a chance as any. It just needs one more little spark, and that is, again, take out the lows. See more selling next week and break out. Oh, and the VIX also, you want to see it take out 36.72. That should put the nail in the coffin, give or take about 37. That's horizontal price resistance right there. And then these targets are just not a lot of reaction points. Once the VIX rockets, it tends to go. That's the previous high from when COVID hit. We'll see if it gets there. And this is also still showing us, as I've said many times, this is where the last two bear markets ended. This was COVID, last bear market, and this was the financial meltdown in '08, exactly to that level. So we're not even close. As much fear as they say this market has, everyone keeps citing this. The AAII, I told you, the AAII sentiment index is not very useful because it's a rhetoric index. People are telling you if they're bearish or bullish, telling you where they expect, but it's not where they it's not them putting their money where their mouth is. The VIX measures short-term volatility, putting call buying really 30 days out, near-term stuff. And then you have the CPC and the CPCE, which I've cited before, and they are still far from my extreme levels that have coincided with the end of the major corrections in bear markets. So that's that. And look, if they can't, if the bulls step in here and defend it, the VIX gets rejected off resistance, could come all the way back to this uptrend line. That would coincide with a rally in the stock market. So certainly not an all-in moment at this point in time. Let me show you what happened near term, and then we'll get away from the stock market. This is a 10-minute chart. I've been watching this today. Just like on the 60-minute, we have some divergences still clinging in there. We had a little bit of divergence on the 10 and 5-minute chart right there. That led to that, was a catalyst for this end-of-day rally, which went right into trendline resistance. And there's a massive level right there. I can just tell you now, this is me, you write it down if you want, 11,775, this level right here. If we get a pop next week, hopefully I'll be able to pivot quick enough. I took on some shorts and I plan to add to those on Sunday evening, depending on what I see, or Monday. And I'll also pivot out of them if depending on what I see. If something convinces me to, as of now, I'm planning to go into next week short. But if I think sniff a potential for a rally, these divergences start to play out. There's some little micro resistance levels, but that's a big one. I would be selling any and all longs that I have as we approach 11,775 and going short, because I think any rally next week is likely to be sold into. And I also right now probably I favor that we won't even do that. Otherwise, if I thought that was the most likely scenario, I'd either go home flat or I'd go home long. So I just want to make that clear. But if we do pop next week, big resistance right there. 5-minute chart. Yeah, you can go down as long as you want. There's a little 5-minute. You can see we had a little divergence right there, divergent low, and rallied up, and same downtrend line I just showed you on the 10-minute chart. So that's where we closed today. That's just a reflexive end of day. Like I said, this reeks to me of a short covering from nervous shorts, taking some profits into the weekend. And, of course, that's always a prudent thing to do, especially if you were hitting it hard today on the short side. Okay, for those of you that kind of follow the financial media, you've probably heard the term TINA a lot in the last year or so. TINA refers to, or stands an acronym for, there is no alternative. And so this goes all the way back to the financial crisis. In the Fed, back then it was Bernanke, came out and outright said it, and they've said it since. One of the reasons the Fed lowers interest rates is it's twofold. It's to spur economic growth, and the other is to force investors, and again, this is not just me making this up. This has been spoken, and it's also known. I've been doing this in former life. I was a stockbroker, financial advisor, and it's known that when rates go down, especially really low like they have been, it forces people out of safe haven in fixed income investments like Treasury bonds and CDs and corporate bonds into stocks, and then it runs the stock market up. And so TINA was, the stock market was high and frothy, and everybody knew it, especially since COVID, but there was no alternative because the outlook for bonds was abysmal. Gold was sucking wind. And so that acronym was used. Well, I just came up with this one today. I'll call it, it's a fancy handle there, Tialua. And that's not a volcanic island somewhere in the South Pacific. Is what there is at least one other alternative, and I'm going to cover those now. So here's my Tialua trade ideas, and again, they're alternatives if you don't short. Now, the whole TINA thing is predicated on people. Most people don't know how to short, don't understand how it works, or just aren't good at it. And I get it. If you're not, don't short. So there's always a way for me to make money. I don't care what, bull, bear market, whether you're in commodities, whether you're in the stock market. If stocks don't look attractive, then if they look unattractive enough, short them and make money. But as far as the alternatives go, there hasn't been much since the beginning of this bear market because everything's been falling in tandem. For the first time in history, we've seen a lockstep trading between bond prices and stocks. They usually go inverse during corrections. Bonds usually go up when stocks fall. Crypto, which originally was presented or talked about as an alternative to the U.S. dollar and to the stock market and traditional financial assets, even that's been falling. But let me cover those, and I guess I'll start there. Talked about crypto. Let's do that real quick. So remember, the Qs were down 1.63% today, and yet you had crypto. We can look at. Let me look at the futures. If you trade ETNs or ETF type instruments, then GBTC you use for Bitcoin and ETHE for Ethereum. BRR Bitcoin futures. These are going to roll next week, so I'm going to show you the September's now, but they expire on the 30th, so everyone's going to start rolling those next week. But relatively speaking, we did good today because it was only, quote unquote, only down 2.23, the futures. Now, what I say by only down, well, remember, the NASDAQ was down almost 2%. Usually, Bitcoin will go up or down a magnitude of the Nasdaq 100 or S&P 500, usually double or so, sometimes triple and even more. So what we're seeing is relative, I'm not going to call it outperformance, but so far, we've seen stocks heading down lately, and crypto is hanging in there, relatively speaking. It's starting to really, and it's holding support. That's the most important thing. Now, it could crap out next week, but right now we have these divergences in place, and you can see it's been building divergences for a while, right where I have the lines, and we're at support. And so I think that is one alternative. It's a crazy concept, but at some point, this super tight correlation between the stock market, crypto, and treasury bonds and gold, all of which are typically flight to safety assets or alternatives. They tend to go up when stocks go down. That relationship may return. So where I'm going is there may be another alternative, more than one. And crypto, again, the way I look at it, I don't have a heavy position. I'll layer into it if the charts start to firm up. I view it as a hedge, just like my treasury bonds. I told you I'm long the long-term treasury bonds, the 10 and the 30 years, mainly the 30s. I'll get to those in 1 second. But I also have some Ethereum and Bitcoin, with the logic being, okay, so I'm short the equity markets, right? And so if that correlation does continue, where they move in lockstep, and next week, let's say on Monday, there's a big gap up in the stock market because something happens, the market rallies for whatever reason, I'll immediately, if I haven't moved out overnight in the futures, remember futures start trading Sunday evening and go through the night. But if I'm still in there, then any losses on my index shorts should be offset by crypto. Now, if I'm really lucky and right on this, then I can actually profit with the stock market continuing to fall, and all of a sudden, people may start realizing, because there's a lot of cash out there. I've read about it, heard about it. A lot of money has been sucked out of mutual funds, bond funds, stock funds, everything, and put into bank accounts, checking accounts. A lot of cash. Remember, the Fed's trying to pull the easy money and excess stimulus out of the economy, but consumer is still flush for the most part. So sooner or later, some of that money is probably going to find its way somewhere. And crypto is possibly one of those. Again, I'm not a long-term believer in it, but I could care less about the fundamentals. I trade things based on the charts. I don't care if there's any value to crypto or if it's worthless. It's probably more worthless than anything in my opinion. But again, if I'll trade it all day long, long or short, depending on if I think there's a move coming, or an attractive risk reward. And again, I'm taking it for the reasons I cited before. So that's a 2-hour candle, 6-month chart of Bitcoin, and that trend line would be a nice target right there, give or take. Rough trend line. Let me tighten it up there a little bit. Looks like that. And then if that broke out, wow, that'd be even more powerful. I could add some levels, but next week after I roll these, I'll mark up the chart of the new futures, the new next month forward. All right, there's a couple levels you can see right there. The other one is Ethereum, ETHE. Let me find that for you. Give me 1 second here as I go through all the charts down on the bottom. ETHUSDRR. All right, same thing. These are going to expire. They'll roll these next week. But you go back a little bit farther. Let me go back to that 6-month. I've covered this many times recently. You had this trading range here, like a coiled spring, building energy, and then a powerful breakout and a big rally. Ended with a divergent high correction, and we've come back and we continue to hold, back test and hold that level, give or take 1265. Additionally, you also have, let me step back down to the a 60-minute time frame. Additionally, you have you're just coming off a divergent low, aka positive or bullish divergence. So this is it. So if Ethereum can break out, we could run next week. So those are, again, I'm keeping positions of those both as a indirect hedge. A direct hedge to a QQQ long would be, or an NQ long would be, puts on the Qs or something else. This is an indirect hedge, and I like indirect hedges because, it should, at worst case scenario, Like I said, if the stock market rallies and index shorts lose some money, and then these guys make some money if that correlation continues. But again, if I'm really lucky, like today at one point, I can make money on both of those. I did with the Treasury, so let me get to that real quick. All right, so ZB, and I already covered that earlier. It had this overshoot here from my experience. That's what I call a price channel overshoot. You had a nice clean price channel. It actually shows better on the 6-month chart, the way I have it drawn. 2-hour candles. There's your price channel. There's your overshoot. Still plenty of work to be done. I'm just going on a working theory that sooner than later, the Fed's going to have to step in and do something about these runaway interest rates on the long end of the curve. It will break something. You have my word that if this continues, meaning this is the long bond falling, meaning long-term interest rates are shooting up. We have mortgages at levels not seen since 2008, and there's no end in sight. This trend is not reversed. Then things will break. Things will break in the global financial system in the U.S. and or elsewhere. And by break, there's many ways, many things that can happen. But just take my word on that. And so that will, at some point, I think at best case scenario from here, the risk reward is starting to look very attractive because, as I said, from a fundamental perspective, we are heading into a recession. We're already in one most likely. The data will come out later to tell us that. And you have long-term bond rates soaring up. And there's going to be, I think, a pretty powerful reversal coming up soon. And so there, you take that trend line break and then the 133.11 level. And then these are your targets right there for a quick trade there. Oh, and like I said, today we were up. At one point we're up over 1%. You can see down here 0.61 positive, 0.6% positive. So my index shorts were very profitable today, and my Treasury bond longs were profitable. So this is another indirect hedge that so far, at least one day doesn't make a trend, but so far today that played out where I made money on both. And next week, let's say the stock market rallies. Well, if the old correlation sticks, then Treasury should rally too. Or if I'm really lucky, then this whole thing with the Treasuries trading with the stock market may come to an end. You may see others that see, especially institutional traders that think like I do, that hey, right now we've got the 30-year bond at multi-decade high levels, the yield in the bond prices at lows, and there's some relative value there because even if this just stalls out, even if they don't do anything to intervene, or they do but it doesn't reverse things much, and you just stay at this level, then you're collecting a pretty decent income on this. I think the yield's like 3 point, I don't know, I'll tell you what it is here. Believe me, I'm not going to be around in the bonds that long to collect 1 year's of interest. So don't get me wrong there, 3.6%, something like that. All right, so that's it. There's TYX, the 30-year yield, TLT. There's a leveraged version if you want. If you go, there's that big positive divergence, the downtrend line. Max target up here about 119.84, and then you can type in Ultra Treasury if that's your thing. If you want a quick trade out of it and you're not going to be in it for very long, UBT. That's got the juice, 200% leverage version of TLT. So there's your targets, 31.93-ish, and then 35.13-ish. Call it 35. All right. Oh, okay. So let's say there is a return to these risk-off assets. They return to their old ways. In other words, Treasury bonds, for example, start to rally with stocks still falling. The other thing is gold. So somebody asked me about gold. They asked about GDX in particular. Well, gold, kind of bigger picture, this is still, in my opinion, was and still is major. It was support. Support once broken becomes resistance, 158. As I've been saying, I suspect that this will probably prove to be a false breakdown. It hasn't happened yet, but that's what you want to watch. Let's keep it very simple. So far, we broke out of this bullish falling wedge right here on gold. We were backtesting it. Gold can't catch a bid. Why can't it catch a bid? Because of the euro and the US dollar. As I said, that is USDOLR. Gold is priced in US dollars, at least the gold we are trading here in the US. If you buy GLD, the gold ETF I just had on, or you buy GC gold futures, or you go down to your local jeweler and you buy your wife or your husband or boyfriend a gold necklace or something, you're buying gold in US dollars. And it's very simple. Gold is priced in US dollars, so when the dollar is higher, it takes fewer dollars to buy an ounce of gold. And when the dollar goes down, drops in value, it takes more dollars to buy an ounce of gold. So if you freeze supply and demand, and I'll tell you, gold's been going down, but it should be falling more than the rate of, again, this is flip this upside down. This is a parabolic run in the US dollar, and this is unusual, especially in the world's largest, the reserve currency. That is a parabolic advance. Parabolic runs have been doing this a long time, never ever end well. They usually end with a very strong reversal. So whether it's intervention from the central banks, Fed and or others, they're already trying. Japan, for the first time yesterday, stepped in 20-something years to intervene and stem the drop in the yen. Bank of England took UK took some drastic steps today with the biggest tax cuts since, I don't know, what was it, in the 70s? You'll read the headlines. You're seeing a lot of extreme measures happening. And again, the system will break if this continues. I don't know where that level is. Nobody does, and nobody knows exactly what'll break, but we do know that you cannot have major currencies and treasury bonds continue at this rate. So that's it. And then the gold will, once this breaks, once you see the dollar reverse, my targets, minimum targets, this uptrend line, that would be a pretty big drop. Next targets this secondary larger uptrend line and the 12,628 level here. And actually one more stop along the way I should include. Trade off of definitely a stop right there. This is what I see happening with the dollar. I see a reversal soon. Right there, bounce there, and then boom. Or at least that'll be it for a while. Okay, so if that happens and gold does well, and the question was about GDX. GDX, number one, first and foremost, will only go up when gold's going up. I've never in my life seen GDX have a rally, a nice tradable trend or rally when gold was going down. So that just doesn't happen. That's that. So we need to see gold reverse. The charts are still constructive. It's still in a downtrend. Broke out, but that was a failed breakout because, again, gold just can't catch a break. We're seeing unprecedented times right now with the strength in the dollar, and that's because, as bad as our house might be in order, things over there in Euroville are just abysmal right now. They've got major problems going on with their dependence on Russian energy, and then the lack of it. So anyway, that's what would have to happen. It's that simple. There are times if you get a powerful sell-off in the stock market, that next leg down I'm talking about, that you could see gold going up and GDX either holding its own or even dropping at the same time. Why? Because GDX holds gold mining stocks. The operative word there being stocks. Gold is not a stock. It is a commodity. It's a precious metal. Barrick Gold, Newmont, they are stocks, and when the stock market falls in a waterfall type sell-off, things tend to get sold indiscriminately. Anything with a ticker. So keep that in mind. But obviously, you want to see if you do see gold moving up, then that's a good sign. Even if temporarily GDX is getting sold down, it may create a buying opportunity there. And then the other big one is oil. Like I've said many times in the past, this is not 1940 or 1849 anymore, where you go out to Sacramento and get a little pan and grab some gold off the top of the creek bed. We've long stripped the earth of surface gold, and we're digging deeper and deeper to get it. And we're not digging with shovels by hand. We're digging with big machines. These big machines take a lot of energy to get down and move the earth and mine the gold, and that energy is diesel fuel and gasoline, all that. So it's always been a boon, a headwind to the miners when energy prices are going up, especially when they're soaring and at multi-year highs, and it's a boon when energy prices fall. So if we continue lower to my next target and current final target on USO or crude oil, which is today we had a good day, down 5.3%. I think we continue more. That'd be another 10% drop. That should be a net benefit for the miners. So like I said, they're not going to go anywhere until gold does. But if you see this and you see a reversal in the dollar and you see gold start to rally, those are all things to look for, and then you can maybe layer in to your position. And if you have a position and it's causing you pain, the old saying is sell down to the point at which you can sleep at night. That's all I can tell you. Right now, the dollar is in an uptrend, and gold is in a downtrend, and GDX is in a downtrend. That's all I can tell you right now. That's certain. The bottom could be into on Monday, or it could be in 6 months from now. There's no way to know for sure, but these are the things to look for to tell us that the bottom is likely in. All right, I think that's it. Let me check my notes. Yeah, that's all. All right, so we'll see. It's going to be an interesting weekend. On a admin or administrative note here, I plan to be around next week on Monday. As of now, there's a tropical storm 9 down there in the Caribbean somewhere, which is forecasted to be a category 2, I believe, a 2 or 3. Somebody told me 3, but I think it said 2. I added the crosshairs here for fact. That's just a screenshot I took to send a friend of mine. But I'm right here. This is really Fort Myers, not Cape Coral, right where I live. If you see. I'm literally the path right now. This is the National Weather Service path. It has that hurricane coming to my doorstep. It's the mouth of the Caloosahatchee River right there where I live in Fort Myers. So if that's the case, that's supposed to make landfall on Tuesday as again a category 2. Now the thing about hurricanes when they're that far out, the one thing almost guaranteed is the path can and will likely change. It's not that say it can't be the same as will the strength of the hurricane. So all I'm trying to tell you is if the weekend comes around, that thing looks like it's coming. I'll either have at minimum preparations to do on Monday. It might keep me away from the desk, or B, possibly evacuate. We'll see, because living on the water at the mouth of the river, that's not where you want to be when if there's going to be a bad storm surge, depending on what the tides are when the thing comes in and where it is. It kicks off winds on one side of the storm more than others. There's all those variables. So I just wanted to say that. If I don't, I'll make a point to get a post out to you if I'm not going to be around on Monday or Tuesday. But as of now, I should be. All right, guys, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.